Hi, I'm Einstein. Okay, I'm Gordon. Um, so D10E conferences are great, and I've had a great opportunity to go around the world speaking on different topics. The main thing I've been speaking about is SAFs, which is a simple agreement for future tokens. And I think I pretty much beat that one to death after having done it 5 times. But the reason I kept on repeating it is every audience that I spoke to about it had some basic questions, some basic misconceptions about it, and it just was necessary. What's happened in the time that's passed is that we've seen several ICOs take place, and several ICOs have problems. So I'm going to do this one a little differently. This is going to be sort of the top 5 greatest hits of what not to do, so that you can sort of back into doing it the right way. So if any of you, and I back this up with real examples of real companies, so if any of you know the founders of these companies that I just lambast here in public, sorry, that's just the way it's going to go. Okay, here's my really subtle disclaimer. Got it? Okay, good. All right. Okay. Who feels that the ICO and token world is full of glamour and excitement? I do. I think it's great. But there's good publicity and there's bad publicity. You don't want to be on this slide next year. Okay, so I'm going to talk about what got these various companies on these slides and provide some proactive guidance about how to do a proper capital raise, about how to do a proper ICO, and we'll kind of see where it goes from there. Okay, so there's 5 rules that I'm going to speak about. And also, I'm going to lay something out here. I mean, I think if you're here at this conference, most of these principles I talk about are going to be self-evident or things, missteps you would avoid doing anyway. But almost all of us, I think, are swimming in a world where you know some people or you're being approached by people who are more willing than others to cut corners and not play ball with the way things should be done. So I just wanted to, I'm not saying anyone in this room would do this sort of thing, but I just want to sensitize you to these issues because they show up in several ways sometimes. So here's rule number 1. Don't commit fraud. Okay? That sounded obvious to me until a couple years ago, but then I started reading some headlines. So don't commit fraud. So what is fraud? Okay, if you want, I'm going to put this legal principle in sort of layman language. Fraud is when you make a material misstatement of fact, or you omit a material fact that a reasonable purchaser or reasonable investor would rely on when making the purchase or investment decision. Huh? It's when you misstate something that's important or leave out something that's important that someone who's making a purchase or investment decision wouldn't reasonably rely on when making that decision. So let's see here. So example number 1, and these are ripped from the headlines. If you say, we have large holdings of real estate, precious metal, and diamonds backing our token, when in fact you're down to your last dollar in your bank account, that is fraud. Number 2, a more proactive, this is also like an express fraud or a direct fraud. Our platform is already built, and we have thousands of active users, when in fact you're still coding the alpha version and only your friends are testing the platform plus your mom. Okay, that's fraud. Here's an example of fraud by omission. Buy our token, we got 10 million in assets backing it up. That's great, but what if you owe 100 million? You think that's relevant? So that's an example of omitting a material fact where if someone knew about it, they would almost certainly make a decision in reliance upon it. No one would ever do anything like this. Oops. Okay, so there is, the name is slipping my mind, actually. I think it was Plexcoin or, anyway, I think I may have lost my lanyard there. Well, no, Bitcoin's not a fraud. But so the first example there is there was a token offering where they said we basically have all this real estate, all these diamonds backing up our token. They conducted an ICO, and they basically had nothing, or maybe $100,000. You may have heard about the crypto bank that just got knocked over. I think it's AV Bank. They actually engaged in proactive fraud. They made misstatements about the assets that they had under management. Big mistake. Okay, number 2 rule of how to do an ICO in a compliant and legally acceptable way. There's an idea I want to get across to the world, which is however neat or cutting edge your blockchain or crypto startup is, it's still a startup. Okay? There's going to be some entity behind it. No matter how decentralized or how distributed you are, there's some. So treat your startup like a startup. So whether that means comply with all the normal legal requirements you would comply with when setting up a startup. You have to decide on the right form of your entity, whether it's a company, an LLC, or a nonprofit foundation, or a combination of entities. You have to choose the right jurisdiction. Jurisdiction matters. What I'm seeing again and again and again is also, with respect to number 2, people are not documenting their relationships. They're not documenting the relationships amongst the founders, amongst the investors, with key executives, with key employees, and with contractors. And in the beginning, everyone's friends, and there's five of you in a room, and you kind of all trust each other. But when it gets bigger and there's real money at stake, that's when things break down. And one particular way that they break down is number 3. Because if you're starting this brave new blockchain or crypto venture, and you have people developing or contributing intellectual property to that venture, unless there's clear documentation of the fact that they're creating it on your behalf or they're transferring it into your venture in exchange for something, then you can roll on for a couple of years, think you're great, and then someone may raise the claim of, wait a second, that's my intellectual property also. Or you owe me part of the company for that. Or I want commissions on every single sale. So headlines are documented relationships with everyone. Your founders, your board members, your contractors, your employees, and especially when it comes to intellectual property. And I'll say also, especially when it comes to who owns what equity in the underlying company. Let's see here. Also, consider tax. I'm seeing the Wild West days of issuing tokens and not having to worry about the tax consequences is gone. When you're issuing tokens, they generally either are securities or they're not securities. If they're not securities, we refer to them as utility tokens. 5 minutes, got it. And I'm on rule number 2, okay. If you're selling tokens that aren't securities, you probably are gonna have to pay sales tax on the money you receive one way or another. If you sell securities, it's a tax-free transaction normally. If you sell tokens that are not securities, you owe tax somewhere. So that's where you need to get an accountant involved. And just for efficiency, I'm just gonna move on here. So this really happened. Everyone's probably familiar with Tezos. You have a fight between the founders of the company and the people, or the gentleman running the foundation. There's a company that has a very witty name called Autonomous. The whole idea behind Autonomous was that you don't need a board of directors. You don't need formal relationships in a company. You can form this all by smart contract. Well, ironically, there's a battle between the CEO and the board of directors, which kind of makes an interesting little mockery of their name. I actually had the new CEO reach out to me and said, please take my name off that article, because he's apparently innocent and trying to clean up after all this. This is an example of what happens when you don't document your relationships and don't have a strong corporate structure. Okay, number 3, this is a short version of the normal presentation I give on SAFs. Again, tokens broadly break down into 2 categories. They're either securities or investment contracts. That's category number 1. Or category number 2 is that they're not securities. We call them utility tokens, but you can call them protocol tokens or just anything else. So you would think that if you're selling tokens that are utility tokens and not securities, you don't need to worry about securities law. Well, that's what you would think. But what this gentleman, Marco Santori, at the Cooley Law Firm threw out there was, if you're selling tokens now, to build and you're going to take the money that you receive in exchange for that sale, to build a platform, which will eventually result in the tokens being utility tokens and not securities. That's nice, but during that initial capital raise, the tokens are securities. They may convert later to be utilities, but in the beginning, they're securities. And he threw that out there. It's not a given that he's right. I actually am going to take a stand pretty soon that he's in some respects wrong. And I actually think that this point of view may have hobbled the growth of the blockchain and crypto worlds. But this is how all the big law firms are doing it. They're saying, you cannot sell tokens before your platform is functional because those tokens will be securities at least while you're building the platform. So instead of selling those tokens, you sell something called a SAFT, which is a simple agreement for future tokens. Now, what the whole world is messing up, shockingly, is not understanding that those SAFTs themselves are securities. Okay, when you sell a SAFT, okay, when you have an agreement for future tokens, that SAFT is a security. Okay, and if you're selling to the United States, you need to find a proper exemption. Usually it's Reg D. You need to sell to only accredited investors in general. You need to make those SAFTs non-transferable. And when and only when the platform is functional, using the money that you raised from selling the SAFTs, only then do you conduct your real ICO, and only then do you convert your SAFTs into the utility tokens. So this is a real thing, and I always say, don't be a munchie. Is anyone in this room a munchie? Okay, I feel very sad for the lawyer who's involved with this because I know this person indirectly, they made an honest try out of doing this right, but they seriously messed up. Now, the SEC, in a moment of angelic grace, did not bring charges against them. They actually called up Munchie and said, you know that thing you're about to do? It's illegal, stop. Now think about it, the SEC called them up and had them stop before doing something illegal. So I don't know what country you're from, or what city, but at least in Los Angeles, if I'm planning to rob a house, the LAPD doesn't call me up and go, Mr. Einstein, you know the house you're about to rob? Can you stop before you do it, and then we want to arrest you? I mean, that's like, Minority Report, Tom Cruise, I'm not so lucky, right? No. And I'm down to 2 minutes. This will be fun. So this poor lady, she had a white paper, which they've since taken down, but I located, where they have a whole legal disclaimer section talking about how their token is not a security. It's going to be a utility because they're going to be able to marketplace, and people are going to trade and add value. And we did the Howey test analysis, and yada, yada, yada. Okay, what she forgot in her 5 pages of analysis is that's nice, good for you, but if you're taking money now to build that marketplace, to build that platform, those tokens are securities. Okay, and that's what the SEC thinks, at least. And the SEC called them up and had them sign that order that's on the left. I can ruin your day. Okay, number 4, and this is kind of related to Munchie and a couple other ones. You can and should build the community for your token. You can and should talk about your plans for making your token and your platform more functional. I mean, you're not meant to be in stealth mode your whole life. But if you're going to sell a token that you're characterizing as a utility token and not as a security, don't go talking about how it's going to massively increase in value the next day after you go public. Okay, that kind of is a good tell that you're actually selling a security. And it specifically goes to the expectation of profit idea in the Howey test. So don't go out there and say, our platform's so good, the price of our token will go up 10 times. That's kind of a mistake. Here's one that's a little bit more subtle. Don't talk about listing your token on an exchange or your plans for listing your token on an exchange. Okay? Now, I personally believe that if you have a utility token and not a security token, it makes that token more useful, not necessarily more valuable, but more useful if it's freely exchangeable. I mean, what's the use of Ether? And, you can't use an Ethereum virtual machine or smart contracts without gas, without Ether. I mean, you need to be able to buy and sell it. But if you start talking about your plans to get a token listed on an exchange, you're kind of leading into the idea that people are going to be able to liquidate their tokens and make a profit. And I was actually just speaking in Amsterdam, and some reporters asked this gentleman who's doing an ICO, what are your plans for listing on an exchange? And the guy said, you know what, we don't talk about that. And I literally, it was Europe, so I didn't know. I want to go over to him and just give him a nice big lawyer hug, because that was the right answer. We don't talk about that, no comment, okay? Is it kind of stupid? Yes. Did he just avoid a major problem? Yes. So that's the way it is. Likewise, lawyers are reviewing. I'm going to go so fast. Oh, only you can pull me off.
You got 30 seconds.
Okay, watch your Telegram, Slack, and Twitter, because have rules. Don't have some 18-year-old intern talking about how the profits that your company's going to make. Bad move. Okay? Yeah, don't. Okay, and this is from the Munchie white paper. Look at this beautiful cycle increasing the value of the token. Do you want that in your white paper? No. That makes it like a security. Here's Paragon Coin with Larry King. Okay, everyone know who Larry King is? Everyone know, I feel sorry for them, but that's an example of not talking up your token from a value perspective. They got this rapper called The Game, which I think I heard one of his songs once. Retain to talk up the value of the Paragon coin. That's bad. Okay, last part. The SEC, the Commodities and Future Trading Commission, the IRS, they are all watching now. So just be careful. Let me throw this out there. If you add me on LinkedIn or send me an email or add me on Facebook, I will give these slides to anyone.
Give him some more time.
Okay, guys, let me explain long-term and short-term incentives. Those short-term, I really love you. Long-term, she runs my life. Okay, so as they say at Goldman Sachs, I'm long-term greedy. Okay, and this is the goddess of stage access. So I'll worship, and she's very classy, and she runs these events just in a really good way. I'm more than happy to talk about this. If you add me on LinkedIn, it's Gordon Einstein. I distribute these slides all the time. Okay, and I'll go back to the first slide, and my email's on there. And Facebook and everything, and by the way, I'm still not your lawyer. Okay, and there you go. So I crammed this down into like 10 seconds flat. I know I talk fast, but there's a lot to cover. I just want to thank you, and I'm happy to answer any questions.